Welcome to TonicBoom, a specialist capital markets podcast series brought to you by Tonic, the expertise-led consultancy dedicated to giving firms more. Join our host, our resident Tonic ninjas, and industry experts as we drop the mic on the hot market topics across high-profile domains such as margin, post-trade, treasury, risk, digital, legal, sustainability, and more. More expertise, more trust, more achieved. Ready for your dose of tonic?
Hi everyone, and a very warm welcome to TonicBoom. For those tuning in for the first time, Boom is Tonic's expertise-led podcast series covering the hottest topics across capital markets and beyond. Welcome to today's episode of From Investment to Impact, Driving Efficiency in Securities Financing. I'm Emma Watson, Tonic Sec Financing Lead, and joining me today are my friends and colleagues Steve Lethaby from Clearstream and Andrew Turvey from GLMX, who both bring hands-on experience and deep insight into how securities financing underpins a cost-efficient business model. So this is going to be a podcast of two halves today. In part one, we'll start by exploring where and why balance sheet cost optimization took centre stage and dig into the current challenges firms face. Then in part two, we'll dive into how the market is adapting and innovating to solve some of these cost pressures head on. From regulatory impacts to tech advances, it's all on the table. So let's get right into it and explore this complex and wide-ranging topic. So Steve, Andy, to kick things off, would you mind giving a quick introduction to yourself, your role, your background, and how it connects to today's topic?
Hi, I'm Steve Lethaby. I'm Senior Vice President, Clearstream Financing Sales at Clearstream, looking after the UK, Ireland, South Africa and the Americas.
I'm Andrew Turvey. I am Director of Sales from here at GLMX. I joined GLMX almost 5 years ago after nearly 20 years at JP Morgan on the repo sales side. I started my career as an interdealer broker and now selling technology in the same market, so it's certainly been a journey from there to here.
Excellent. Thanks, guys. So let's break the ice in true TonicBoom style by doing a quick round of one truth and two lies. The theme today is our first jobs. And as we have a theme, I have switched the format slightly from the classic two truths and one lie to one truth and two lies. So I want to know what your first job was, but with a twist, you're going to try and throw us off by giving us two lies and just one truth. Let's see if we can spot the real one. So Andy, did you want to go first? And then Steve, let's save yours for part two.
Thanks, Emma. So before moving into repo, I worked for almost 5 years in relationship management, but made the transition into securities financing when I realised it was the most exciting product with the smartest dealers, and I was desperate to be a part of it. Number two, I was the only person in my graduate intake whose degree was in Latin with a specialism in erotic poetry, which has been remarkably useful. And three, it was my ability to curse fluently in an obscure Japanese rural dialect that landed me my first job in repo.
Oh my goodness. Okay. I'm not sure if we should stay away from the erotic poetry.
Well, there is an obvious one there, but I'm more interested to hear about the cursing fluently in Japanese. I know what you're like, Andy. When you curse, to hear you in Japanese actually might not be a bad one. Can you give an example or?
Dekinam on here.
No, you're not going to share today.
No, okay.
Oh, I think we can cross that one off then, Steve. Yeah. I'm not going to ask you to recite any erotic poetry either. I actually have a suspicion that it's number one.
I have a suspicion.
Yeah. I think Andy has excellent relationship management skills, and I know that he's passionate about repo.
Much as I hate to crow, it is in fact number three.
Oh!
The Japanese rural dialect.
Yeah, essentially, very briefly, I applied for a job at the back of the Evening Standard for people with obscure languages, and I spoke fluent Japanese after spending some time there. And so they put me on the phone with a gentleman from a Japanese bank and to test my Japanese. I saw him fluently in very rural farmer Japanese. And the guy said, I've never heard anyone speak like that, hire him immediately. And that's how it started.
Okay, we've definitely learned something new today. Thank you.
We digress.
Yes, yeah, let's crack on. So thanks, Andy, that was a fab start. So now we're going to shift gears and dive into our main segment, which is From Investment to Impact, Driving Efficiency in Securities Financing. So let's get into it. So this topic, I'd say, isn't exactly new. The efficiency and cost optimization drive has been on the radar for a number of years. But I'd say for listeners who might be newer to the space, it's probably worth taking a moment to frame what we actually mean by cost optimization in sec financing. So for me, it's about how firms have progressively become smarter with managing their processes, their technology, their counterparties and their collateral. The goal is to drive down costs and boost efficiency across everything they do, across repo and sec lending. It's about making every part of the trade lifecycle work harder and smarter, but achieving these types of goals requires a willingness to invest funds and resources upfront in order to unlock that type of value. The type of efficiency we'll be referring to today is much more than simply looking for opportunities to cut costs. It's really about leveraging operational precision to create strategic advantage. So, moving on to where this all started, Andy, would you maybe like to give us some insights as to when did the market's heightened focus on balance sheet cost optimization really start? And what would you say were the key drivers for this?
Thanks, Emma. As a seasoned market practitioner, I'm firmly of the opinion that as repo markets have continued to grow, both in terms of volumes and participants, they've been a constant state of evolution. I think it's fair to say, and correct me if I'm wrong, Steve, that the repo and lending markets were slightly slower to adopt these kind of innovative technology than other kind of adjacent products. But certainly post-GFC, the pace of change really stepped up. I think pre-GFC, the processes on the day-to-day desk were very clunky, operationally intensive, with imperfect manual input leading to significant settlement fails, misbookings, which obviously gives rise to compliance reporting issues further down the line. As volumes in the market grew, it became clear that this kind of legacy analog processes were no longer fit for purpose, and the market started to look for more efficient and scalable solutions which could remove much of the operational burden while simultaneously allowing both traders and salespeople to focus on the real value add, the sharing of market intelligence, of strategy, of understanding what your clients, what your dealers are looking to do. So the global financial crisis happened, and it really shook the market up. So it's never really been the same since. So the regulation that came after that sort of unleashed a plethora of binding constraints across the board, aimed to develop a more robust and resilient infrastructure. As we'll all be familiar with, there was a host of acronyms that came into play. Basel's 1, 2, 3, Endgame, RWA, ROE, LR, SLR, NSFR. We could do this for a long time. It's a whole separate quiz. But I think it's important to bear in mind that institutions across the globe were subject at this time to different regulatory requirements. So there was no consistency across the board. This very much drove the need for more efficiency and transparency through every stage of the trading cycle. So there were some initial early adopters, there were some fast followers, but I think now we've reached the inflection point where this kind of electronification of the repo market from front to back has moved from nice to have to almost impossible to live without. And I think what's driven that really is the buyer side and the sell side collaborating to understand the binding constraints on both sides and coming up with a model that was both scalable and achievable.
Excellent. So you mentioned the GFC there, and I think any of us that have worked in the industry for as long as perhaps the three of us have, remember how things were before and after. So I put the question to you both really. Do you think things have changed for the better or worse since the GFC?
Well, from my perspective, I've been sitting on the fence here. I'm going to probably say yes and no. Okay, so no surprise there. And the reason why yes is obviously the regulation that Andy talked about earlier, the Dodd-Frank, Basel III, all the other things that have come in since. There's more transparency now in the market. So a lot of the market on the repo side moving to CCPs for their funding and financing. The ability to stress testing of the banks I think has been extremely important. And also the innovation that we are going to be talking about going forward, leading to efficiency, things like algo trading, retail platforms, a lot more access for retail clients to actually start investing in the markets. The risks that still remain are banks are getting bigger due to the fact they're merging. So the too big to fail is still there. We now have a rise of the shadow bankers side with regard to the hedge funds and the non-regulated companies that have grown, potentially less oversight on that. We've got still have continued central bank intervention whenever there's any sort of hint of a crisis, meaning market fragility is still there as well. So flash crashes, things like SVB, for example, 2-3 years ago now. So overall risk has shifted from the big banks to the shadow banks and from obvious leverage to probably a more subtle leverage.
Absolutely. Andy, anything you want to add to that?
No, I think Steve makes a very, very good point that the risk has shifted, and I think there's a lot of regulatory focus now on the NBFI and how they can be more effectively regulated. I think, way back in the day, there was an assumption from the regulators that the dealers would take a hand in regulating the NBFIs. I think that the scalability of some of the technology has enabled these NBFIs to grow to very significant size and significant market share. So I suspect that's no longer a kind of a methodology that's going to hold water anymore. So I know that whether it's clearing, client clearing, whether it's different regulation, minimum mandatory haircuts in this space, there's definitely a lot of focus on that, and I think there will continue to be so. Mindful, of course, that it's all about the cost.
Yeah, absolutely. So moving forwards, We've spoken about where the big focus on cost optimization started. Steve, would you be okay to talk a little bit about where you feel the market sits with this right now? Do you think the market has made good strides, or do you think firms are still facing major challenges in this space?
I think firms have made good strides, but it's basically due to the fact they've been put in the position to do so. So we talk about the post-2008 shift. So regulatory frameworks have made balance sheet and capital costs central to the organisation. Firms now manage their security financing more strategically, and cost attribution and optimisation frameworks are becoming far more important. I think that the key developments that have happened since that time have been, from my perspective, which is a great one, is obviously adaptation of tri-party repo. So I wouldn't be here if I wasn't going to blow my own trumpet or my company's own trumpet of what we do. We're not the only repo agent out there. CCP clearing has also been important to reduce operational costs and reduce capital usage and counterparty risk. There are some collateral optimisation platforms out there. They are probably still very much in the early days, and we'll probably go into that in more detail later on as to where they are and what the future is for that. You have your funding desks, so it's a lot more centralised now, centralised treasury, pooling of resources. You've got the funding cost optimisation. I think when you look at data analytics, that's improved now as well. So I know we as a company are focusing a lot more attention on that as well. And this is obviously used for decision making and balance sheet management tools. A lot more of that is out there now. Internal cost model factors, liquidity, RWA, that type of thing. And also the HQLA treatment along with the funding costs that are involved in that as well. But, and I say but, there are still key gaps here. So I think you still find there are siloed systems within organisations. So, you've got banks that have different areas that look after different parts of the business that really should try to bring that together, which also means data fragmentation as well, which I suppose in a way it's based on legacy infrastructure, and that obviously needs to be looked at as well. An overhaul of maybe what they currently have in place. And I think the regulatory complexity also doesn't help businesses either, because the constantly changing rules, new regulatory rules coming through, make it very difficult for them to optimise efficiently. I'm going to quickly mention ESG because it was a buzzword a few years ago. It seems to have gone off the radar a bit, but I think it hasn't gone away. And I think the ESG pressures and how inventory and funding is sourced is still going to be there.
Absolutely. All very relatable, and just really interesting the point you make around the cost of regulation versus the much needed funding that a lot of banks and firms require in order to transform their key sort of underlying legacy platforms to sort of build that much needed consolidation that you were just referring to.
Absolutely.
So all of those drivers make perfect sense and are totally relatable, especially to someone like me who's spent most of their career working on the sell side. I am quite intrigued as to what you think the key impacts are to the buy side as well.
Well, the buy side were always very enthusiastic adopters of the technology, as they're, as ever, they're hyper focused on efficiency and the ability to manage their margins and their costs, essentially to do more with less, which has always been a key kind of component of the repo market. I think the ability to transact significant volumes of business, particularly in the shorter dated super liquid space, has enabled this NBFIs to really scale their flows while still maintain the very highest standards of risk and relationship management. I think the biggest challenge that we face as an institution is all moving forward at the same speed. So I think, the market has now moved over to this electronification. We're still in the early phases of really, I think, reaping the benefits of that. It all comes down to costs. So it comes down to the buy side and the sell side working together, both to garner the resources to take them to the next level of integration in STP, which is going to make the market more transparent. It's going to make more data available to make informed contextual trading decisions. I think there's a long way to go. We've got the momentum. We just need to keep pushing forwards as an industry as opposed to buy side and sell side.
Absolutely. That key point on sort of partnership and collaboration, I think, is absolutely key.
Can I just say one quick point on the buy side? If you include corporate treasuries in the buy side as well, post-2008, we've had a number of corporate treasuries come onto our platform, as in they're giving cash and taking collateral, and that can all be managed within collateral management. So that, I think, that's been a massive plus for that part of the buy side industry as well.
Absolutely.
It's making this whole market more attractive to new entrants, which is what we're kind of all beholden to do, right? And
it's what the banks want as well, yeah? So you talk about NSFR, then that's one of the key points for them in the corporate world is that they want corporate cash.
Absolutely, you need both sides of the trade.
And we've got to make this market more accessible, more open, more transparent and more efficient in order to attract those new entrants.
Okay, so thanks for that, guys. So we've spoken about where the cost optimization started and where we see it at now. Let's maybe wrap up with Andy, your thoughts on where you think it needs to be next.
I think just to reiterate the point I made just a couple of minutes ago, I think we're on the start of the journey towards fully reaping the rewards of increased digitization. That is going to make the market more transparent. It's going to make the market easier to operate. It's going to make the market more liquid. It's going to make it safer and more transparent. And I think all of those things are going to continue to attract new cash, new collateral into the market. And I think, it's definitely all about being cohesive as an industry. So spending time in seminars, working with each other so that both sides of the trade understand the binding constraints and what we need to push this business forward.
Absolutely. And just one other big point that I'll add, if I may, I don't think we can complete this podcast without talking about T+1 in UK and Europe. So as I think probably most listeners will appreciate that, firms have until October 2027 to make significant changes in their post-trade environments to support the automation and the data standardization that will be required to support the switch to T+1 settlement. I think everyone will probably agree it represents a huge change to the markets. So don't quote me on this one, but I did hear from a reliable source recently that some data crunching has been done, which shows a shift from T+2 to T+1 will represent an 83% reduction in post-trade processing times for firms. The reason I wanted to sort of mention that data point today is I think it really demonstrates how critical the efficiency drive will be here in the form of automation and standardization. So I won't go into any more detail on that one now, but watch out for an upcoming TonicBoom episode where we will dive deeper into that one. Okay, so one final question to go. Guys, how likely do you think it is that the UK and Europe will follow suit with the US and mandate the central clearing of gubbies across the short to medium term horizon? So start with you, Steve.
Well, I know that obviously the US has delayed it now until 2026, and from the conversations I had in the US last week, it looks like that would probably be extended, and given the current government setup, who knows what's likely to happen with that in the next couple of years anyway. I think that the buy-side firms are obviously more affected due to the fact that they're not currently members of the CCP. So as we know, they will need sponsored membership, which will mean new margin requirements and settlement workflows.
Yeah, I think that makes perfect sense, Steve. I think the consensus certainly amongst the guys we talk to here, both on the buy and the sell side, is that client clearing, central clearing will be a very useful tool to have in the toolkit. But there are numerous headwinds in terms of cost and adoption, particularly with regard to margin and margin maintenance, which means it's not a straightforward slam dunk. There are challenges that need to be resolved, questions that need to be answered. But yes, good to have.
One to watch.
Definitely one to watch. Definitely one we'll be talking about a lot more. We've been talking about it for a while in these markets. I think it's becoming more and more of an issue. I look forward to seeing what options are available.
Feels like another podcast topic. Okay, so thanks, Steve and Andy. So we still have loads to cover on this topic, which we're going to break out into part 2 of this episode. Steve, Andy, really appreciate your time and perspectives. We'll hit pause here, but we'll be picking this conversation back up in part 2 of From Investment to Impact, driving efficiency in securities financing, so stay tuned.
You've been listening to TonicBoom. Don't forget to like and subscribe to stay up to date on the latest developments and industry opinion across capital markets. Visit theTonicConsultancy.com to see more of our expertise-led insights and end-to-end solutions. Tonic. More expertise, more trust, more achieved.